So on the equity side, we expect the MSCI Asia ex Japan to end 2017 slightly below current levels at 520. This assumes a forward earnings growth of 6% versus consensus at about 10.5% and a forward PE de-rating to 11.8 times versus the current level of 12.5 times. So I just want to briefly highlight 3 points from our equity strategy piece. First, while I mentioned that it's a largely flattish outlook, we don't actually expect a straight line performance, but we are looking more at a V-shaped trajectory. So we are looking for a weak first half performance followed by a stronger second half performance. Essentially, based on our US team's view of growth and bond yields under Trump policies, we expect a stronger dollar and Asian equity outflows through most of the first half. This should put downward pressure on Asian equity valuations, but then later in the year, these pressures should ease and some flows may tentatively resume. In addition, we see near-term cyclical slowdown in commodities and the industrial space in Asia starting from sometime in early Q1, with additional downside risks potentially from firstly a rise in China credit spreads and capital outflows, as Rob mentioned. Secondly, a slowdown in the semiconductor cycle where we have seen some tentative signs. And thirdly, a rise in European political risks. All these essentially imply weakness in both earnings and multiples in the first half. Secondly, in terms of timing, we haven't yet positioned for such downside as of now, and we remain neutral on AJ equities. We think that the timing will come sometime in early Q1, like I mentioned. But importantly, sentiment indicators that we have successfully used this year we think may be less applicable in 2017 as market correlations are likely to fall, and this is partly due to Trump's protectionist inclinations as well. Instead, I would say that we will have to rely more on policy indications and US bond and FX market movements. Finally, in terms of allocation within Asia, India is now our top overweight market. We see the transitory impacts from the demonetization offering an attractive entry point in what Sonal highlighted remains a very strong macro story. Similarly, our other structural overweight call is on Asia, where despite some anticipated near-term volatility on flow pressures and local politics, we see one of the better growth outcomes next year. We also have a tactical overweight calls in China and the Philippines. In China, although I mentioned about rising risks, we see them for now offset by continued strong flows into the HK market through the Stock Connect program. And on the other hand, for the Philippines, we believe that potential political risks are overpriced at this point, and markets are ignoring the strong fundamentals. Elsewhere, we have downgraded Korea to neutral as the earnings momentum is starting to fade. That said, we are vigilant on the need to upgrade again should political developments lead to a revision in corporate law towards mandatory cumulative voting. As you notice, President Park has already been impeached this afternoon, and this process could start sometime in the coming months. On the other hand, we have downgraded Malaysia to underweight given the poorer growth outcomes that we are expecting now and a rising consensus about election-related upside. And on the other hand, we have upgraded Thailand to neutral. We had downgraded the market following sharp gains in Q1, but at present we see a slightly improving growth outlook, continued positive sentiment on the government's support to the economy, as well as some insulation from foreign outflow-related downside given the largely domestic participation there. So with that, I'll stop there and hand it back over to Rob.
Thanks, Mixo. And maybe just to round this up, given our Northeast Asia economist Yong Sun Kwon could not make this call, let me just make a very brief comment on Korea and Hong Kong. So for South Korea, we have a cautious outlook. We expect GDP growth to slow from 2.7% this year to 2% next year. The reasons: political uncertainty and a housing market correction. And we expect belated monetary policy stimulus in the second half of the year after a possible early presidential election, which is looking increasingly likely now in the first half. For Hong Kong, we are actually very cautious. We're expecting GDP growth to slow from 1.5% this year to 0.5% next year. Hong Kong really is stuck between a rock and a hard place. We think higher Fed policy rates, a stronger trade-weighted Hong Kong dollar is going to weigh on the economy, and we also expect house prices to resume their correction next year.